Welcome to Dual Edge Research, where we provide disciplined, data-driven strategies designed to help investors succeed across multiple markets. Dual Edge Research publishes two powerful newsletters that work great individually and even better together. The Bull Strangle newsletter focuses on stocks and options, combining stock ownership with premium selling strategies to generate consistent income and market-beating returns. The Smart Spreads newsletter specializes in seasonal commodity futures spreads, offering a diversified approach with low correlation to equities. Together, they deliver a complete investment perspective, one focused on income, the other on diversification, all under one simple subscription. Two powerful strategies, one disciplined source. Dual Edge Research. This video will focus on the Bull Strangle newsletter, a disciplined, structured approach designed to generate consistent income and long-term performance through a balanced combination of stock ownership and option selling. In this video, we'll take a detailed look at one of the most important aspects of the Bull Strangle strategy, how margin requirements and capital are managed. The Bull Strangle approach combines long stock ownership with dual option selling to generate consistent income. But unlike leverage strategies, it's designed to operate entirely within the limits of available cash, with no borrowing and no margin loans. We'll explain how brokers calculate margin, why those numbers differ across platforms, and more importantly, why they don't actually matter when trades are fully cash secured. You'll also see how the strategy maintains a built-in 25% cash reserve to protect against volatility, avoid forced liquidations, and ensure there's always dry powder for new opportunities. Finally, we'll introduce the concept of cash available without margin impact, the single most practical measure of true capital availability and the foundation for how all Bull Strangle returns are calculated. By the end of this video, you'll understand how the Bull Strangle strategy keeps capital fully deployed, risk tightly controlled, and flexibility high, all without ever relying on borrowed funds. Before we jump into the margin and capital management topic, you can learn more about the Bull Strangle strategy on our YouTube channel. Just search Bull Strangle newsletter and you will find a comprehensive set of videos that explains the strategy in detail. In this 4-part video series, we'll take you through every aspect of our proven strategy. We'll start with a fundamental options overview, then dive deep into our core strategy, explore risk optimization techniques, and finally, show you how our newsletter can help implement these concepts in real-world trading. At the heart of our approach is a powerful 3-part strategy that combines stock ownership with both covered calls and cash-secured puts. This integrated method creates multiple income streams while managing risk effectively. By selling out-of-the-money calls and puts 4 weeks out, we create a systematic approach to generating consistent returns. Now let's dive into the main topic for this video, margin requirements and capital management. Margin requirements can look complicated, but here's the simple version. Under Regulation T, which is a rule established by the Federal Reserve Board that governs how brokers can extend credit to investors, most brokers require 50% of a stock's value as margin when buying on leverage. For example, if you buy 100 shares at $100, the position has a $10,000 notional value. In a margin account, only half, or $5,000, must be posted, with the rest borrowed. In a cash account, however, the full $10,000 is debited because no borrowing takes place. On the covered call side, no additional margin is required. The call is fully covered by the owned shares, and the premium you receive is immediately credited to your account, slightly reducing the overall cost of the trade. The short put is the only leg that creates additional margin exposure. Under the standard Regulation T formula, margin equals the option premium plus the greater of 20% of the stock value minus the out-of-the-money amount, or 10% of the stock value, multiplied by 100. In our example, with a stock at $100, a $90 strike, and a premium of $250, the margin requirement comes to about $1,250 per contract. That represents the potential downside risk if the stock drops, and the option is assigned. So, while the Bull Strangle strategy involves both long stock and short options, it's important to remember that the covered call side adds no margin impact, and the short put defines a clear, measurable capital requirement. When we combine the stock call and put, the total margin impact is about $6,250, but the call option premium received offsets that amount, reducing the net working capital required to $6,000. That means a trader controls $10,000 of stock while committing only about 60% of that in actual capital. It's important to remember that margin formulas vary widely between brokers. Two traders can hold identical positions but see completely different margin numbers depending on their brokerage platform. But here's the real takeaway. Margin calculations only matter if you're borrowing money, and the Bull Strangle strategy never does that. This approach is not designed around leverage. It's designed around disciplined capital allocation, consistent position sizing, and steady income. A core part of that discipline is maintaining a 25% cash reserve at all times. That cushion keeps the account liquid, ensures you can handle drawdowns or assignments without stress, and provides dry powder for new trade opportunities. Because this cash reserve is always maintained, margin borrowing is never a factor in implementing the strategy. Instead, the focus is on using available capital efficiently, not stretching it through leverage. That's why, in practice, margin math takes a back seat in the Bull Strangle framework. What truly matters is maintaining structure, liquidity, and consistency. Risk rule number 1 in the Bull Strangle strategy is to limit total exposure to 75% of investment capital, keeping 25% in cash. That cash reserve is the backbone of the strategy. It cushions volatility, prevents emotional decision-making, and keeps you from being forced to sell during temporary drawdowns. It also gives you dry powder to buy when markets pull back, turning volatility into opportunity instead of risk. Holding cash is one of the simplest forms of risk management. It lowers portfolio volatility, smooths out returns, and eliminates the danger of margin calls or forced liquidation. In short, cash isn't about missing out. It's about staying liquid, staying disciplined, and staying in the game. One of the most practical concepts in the Bull Strangle strategy is cash available without margin impact. Instead of worrying about complicated margin formulas, Bull Strangle traders focus on this single, reliable figure found in every brokerage account. It represents how much cash can be deployed for new trades without increasing margin exposure or triggering a loan. In other words, it's the real-time amount of capital that's free to use safely and efficiently. The relationship is simple. Cash available without margin impact equals the value of the stock held minus the option premium received. Let's go back to the current example. If you purchase 100 shares at $100, that's $10,000 of stock value. You sell both the call and put options and collect a total of $500 in premium. That means your cash available without margin impact is $9,500, fully secured, no borrowing, no leverage. This is the figure the Bull Strangle newsletter uses to calculate returns because it reflects true cash usage and gives a consistent measure of performance across all positions. Now, here's how capital frees up week by week, assuming that the stock remains near the purchase price. As the options decay through the 4-week expiration cycle, the option liability gradually disappears. Cash available without margin impact rises from $9,500 at entry to $9,675 in week 2, to $9,825 in week 3, and finally to $10,000 by expiration. That steady release of capital allows new trades to be opened each Monday as the prior week's options expire. It's a simple, disciplined rhythm of renewal, cash always working but never borrowed. As we wrap up, let's bring everything together. The Bull Strangle strategy simplifies capital management by focusing on one clear metric: cash available without margin impact. By using this single measure, traders gain three key advantages. First, a simple and consistent view of liquidity, regardless of which broker they use. Second, a clear understanding of how much capital is currently deployed versus how much remains free. And third, a disciplined framework that completely avoids the risks of margin borrowing. This approach fits perfectly with the Bull Strangle philosophy: stay fully funded, collect steady option income, and maintain flexibility week after week. In short, margin math may be complex, but it becomes irrelevant when every trade is fully cash secured. By keeping 25% of capital uncommitted, the Bull Strangle method eliminates margin risk entirely and manages exposure through a simple, transparent lens. This one number, cash available without margin impact, tells the complete story: how much is invested, how much is free, and how your capital quietly refreshes each week as options expire and new opportunities appear. Looking for consistent profits in both stocks and commodities? Now you can get two powerful newsletters for one simple price. For stocks and options, the Bull Strangle newsletter shows you how to combine stock ownership with dual option selling, a disciplined strategy that has consistently outperformed the S&P 500. For commodity futures, the Smart Spreads newsletter focuses on seasonal commodity spreads, a proven, low-correlation approach that thrives in all types of markets. While each newsletter is designed to deliver consistent income on its own, but when used together, they create a complete, diversified trading approach that works in any market environment. Subscriptions start at just $49 a month, with deep discounts on 3-month, 6-month, and annual plans. And right now, for a limited time, your first month is only $1. There's no long-term commitment. Cancel anytime. So don't wait. Visit bullstrangle.com/products. That's bullstrangle.com/products. And start trading smarter today with the Bull Strangle and Smart Spreads newsletters.